Good morning, everyone. We've got a very exciting year ahead. We've got a full suite of products and services to provide our clients with a holistic offering. And on top of that, we've had very decent performance over the last while. The bull market, which started in October 2023, remains intact. We have strong economic growth, earnings growth, the prospect of further interest rate cuts, and a very exciting supply side economic policy in the US in the offing once Donald Trump is inaugurated. So the agenda this morning, I'm going to be talking about the risks to the market over 2025, both negative and positive. And then just a little bit of fun at the end. I'm going to go through some fun or some interesting facts. Some of them you may well know already, all related to the markets, of course. So let's kick off then. This is some material from Capital Economics talking about the risks, both negative and positive. The first risk that they identify is a global trade war. The key trigger for this would be if other countries respond aggressively to US tariffs. But according to this report, our forecasts assume that the incoming Trump administration will impose sizable tariffs on US imports, but that retaliatory measures by other countries will be designed to avoid escalating tensions with Washington. So a fairly reasonable outlook. In the worst case scenario, however, a global trade war at the extreme could knock 2 to 3 percentage points off global GDP. And that, of course, would be calamitous for the markets over the short term. Risk number 2, inflation flares up again. The key triggers: broad increase in tariffs, widespread measures to limit migration, fiscal expansion. In our central forecast, we assume that higher tariffs will push US inflation towards 3% in 2025. But this is best interpreted as a one-off upward shift in the level of prices. All other things being equal, inflation will then settle back in 2026. Risk number 3, fiscal missteps. The key triggers: attempts to push through additional deficit-financed tax cuts in the US, a sense in markets that fiscal guardrails in advanced economies more generally are weakening. Several advanced economy governments will run fiscal positions in 2025 that test the limits of the bond market's patience. And MRB has been talking for a long time about the risk. One of the key risks that they have cited is a further run-up in US 10-year Treasury bond yields. They've shown that every time that bond yield rises above a previous peak, then there is a sizable correction in risk assets. So the previous peak in the 10-year Treasury bond yield was 5%, and that led to the bear market that we had in the first 3 quarters of 2023. If it goes back above 5%, of course, then that will be a signal to reduce weighting in risk assets. So we're keeping a close eye on that one. Risk number 4, the stock market bubble bursts. Key triggers: disappointing big tech earnings, evidence of slowing AI rollout. Our view is that 2025 will be another good year for US equities, with the S&P 500 on track to hit 7,000. A bubble keeps inflating around technology stocks as investors attempt to capture the benefits of the technology ahead of them crystallizing in the real economy. But our judgment is that the bubble has further to inflate, although it is possible that it could burst earlier than we anticipate. So now, two upside risks. The first one, an energy glut develops, key triggers, OPEC Plus opens the taps. For the past several years, OPEC Plus has constrained supply to try to prop up prices. But this strategy has not delivered the intended results. This raises the possibility that Saudi Arabia and other influential cartel members might shift from a strategy of trying to prop up prices to one of capturing market share from higher cost producers. In other words, 2025 could be the year in which OPEC Plus opens the taps. If this were to happen, oil prices could collapse. And of course, that would be enormously beneficial for the inflation hawks or the monetary policy hawks or those worried about bond yields rising too high. Risk number 6, the growth stars align. Key triggers, multiple triggers, but would need to be facilitated by faster productivity growth. And we are seeing that occurring, especially in the US. It is natural for economists to concentrate on the downside risks to growth, but 2025 could be the year where the stars align on economic growth. At the same time, bank lending, which has been notably weak over the past year, could pick up on the back of interest rate cuts. And while we do not expect major stimulus in China, it is possible that monetary and fiscal support is greater than we anticipate. So let's move on to MRB's forecast. I'm really just going to look at the US economic growth and market forecast in this instance. 2025 is generally favorable. US economic growth is healthy, corporate earnings are rising, and monetary policy is non-threatening. And optimism about deregulation and tax cuts will sustain positive earnings and provide ongoing support to stock prices. They do cite a couple of challenges. At 22 times next year's earnings, the equity market in the US has already front-run a lot of the good news. High valuations leave stock prices vulnerable to adverse developments such as upside pressure on bond yields or earnings disappointments. The second challenge is that President-elect Trump, his policies bring both upside and downside risks for the economy. Deregulation and tax cuts are good for growth, but tariffs, curbs to immigration, and the cuts to federal government spending that may occur by the Department of Government Efficiency are growth unfriendly. We expect the incoming Trump administration to ultimately prioritize stock market performance as a measure of success and not jeopardize the economic expansion. Implicit in this assumption is that Trump will enact US tariffs selectively rather than universally. And then finally, Alpine Macro, their forecasts for different market segments. First of all, the US, they feel the US will continue to outperform in 2025, despite its high valuation, an expanding productivity gap with the rest of the world reduces the odds of a sustained downturn in US relative earnings growth. On Europe, they are underweight. Insufficient policy action will cap euro area earnings and valuation multiples. On emerging markets, they are neutral. A global manufacturing recovery, emerging market monetary easing, and an ASEAN capital spending boom should bolster emerging markets' profits. China's policy pivot could supercharge EM earnings and equity performance. Growth stocks outside the Mag 7 could meaningfully contribute to the next performance upleg. And they're keen on small cap stocks. Small cap outperformance is premised on easing financial conditions, brightening earnings prospects, and a potential unlocking of a substantial valuation discount. So what we saw in 2024 was a strong dollar, particularly after Trump was re-elected, and the outlook is for the dollar to continue outperforming in 2025. The dollar is poised to strengthen on the back of Trump's anticipated policies, which should further shift economic momentum from the rest of the world to the US. And finally, on oil, US energy deregulation cracks in Saudi Arabia's commitment to production cuts and drawn out Chinese stimulus all point to downside for oil prices. So turning to capital economics, just a few of their forecasts, and these are all forecasts in US dollars. And because of the US dollar strengthening, it does explain why some of the non-US dollar asset classes look like they're underperforming quite badly. For instance, US Treasury bonds total dollar return in 2025, 4.5%, whereas developed market government sovereign only 1.4%. So those are developed market sovereign bonds excluding the US. Decent returns from investment grade and high yielding corporates of 3.5% and 5.8% respectively. On equities, precious metals still positive at 4.3%. So just a couple of interesting facts. First of all, it may surprise some, not necessarily all of you, that the China 30-year government bond yield is now below Japan's 30-year government bond yield. So the market is telling us that China is heading for a Japanese-style deflation. So that is a little bit worrying. It could, of course, ignite the massive stimulus is needed, but if not, then it definitely sets off a bit of a warning bell. And then the other interesting facts, regional index weightings. So the US equity market accounts for approximately 67% of the global total. That is the highest in more than 50 years. But this will interest you. In 2010, the US was only 40% of the global total, and in the late 1980s was only 28%. And also in the late 1980s and 1990, Japan was over 40%. So a whole 35% more than the US. So from having been 42% in 1990 at the peak of Japan's stock market bubble, it has now dropped to just around 5.5%. Astonishing. The euro area has dropped to below 10%, having been 20% in the late 1990s. And the UK was 12% in 2004 and is now below 4%. So things really do move. Very important to have a globally diversified portfolio. Technology now represents some 83% of global technology market capitalization and more than 20% of global overall market capitalization. Yeah, so pretty interesting indeed.
Morning, Nick. Morning, everyone. Thanks for that insightful update. I don't think the local side would be as exciting as the global side, but we'll give it a go. I'll just touch on one or two data points which we ended off last year to sort of set the scene for what we expect for 2025. I mean, we've been talking about inflation and interest rates quite a lot last year, so just quickly touch on that. We had CPI data that came out for November, and basically the trend of low inflation continued. The November CPI figure was 2.9%. So just to refresh everybody's minds, the goal from the South African Reserve Bank is between 3 and 6%, with sort of a midpoint at 4.5%. So having inflation below that is fantastic if you think about where we start at the beginning of the year. Then also core CPI, which excludes food inflation and also fuel and energy, was 3.7%, so also below the midpoint. And then producer price inflation for November, which basically feeds into, was a leading indicator for CPI. That was minus 0.1%, mostly driven by lower fuel prices. So I think in summary, the inflation picture in South Africa very much under control at this stage, with a decline in prices sort of across the board. I think inflation is one thing, but I think the big question is, what does that mean for interest rates? So if we look at the forecast that's in the Reserve Bank's model at this stage, they expect another 50 basis points of rate cuts for 2025, which would bring the repo rate down from 7.75% down to 7.25%. Still fairly high. I would say it is a low rate, but it's much better than what we had in the beginning of the year. And then there's an outside chance of a 75 or even 100 basis point rate cut. So 0.75% or a full 1% cut. So I do think with uncertainty regarding policy from the US in terms of tariffs and the impact that might have on emerging market currencies such as the rand, the Reserve Bank would probably quite careful. So I think we'll probably see 25 rate cuts for now, and maybe we'll get a bit of a surprise at the end of the year. But yeah, all in all, the inflation picture is quite positive. I think just to summarize last year, before we sort of jump into what we see for 2025, I think last year was sort of a year of two halves. We had a lot of uncertainty, political uncertainty when we started the year last year, and markets were sort of depressed. And then in the second half of the year, we had better markets. We had the formation of the GNU and quite a big turnaround in sentiment, business and consumer sentiment. What we did not see is a significant turnaround in the real economy. There was one or two data points that was positive, but all in all, I think the big turnaround in the real economy that we were hoping for hasn't really materialized yet. However, I think moving to 2025, I think from an outlook point of view, I think we are fairly optimistic or cautiously optimistic. And I think just that's based on just the starting point. If you compare this year's starting point to last year, as I mentioned, we had quite a lot of political uncertainty with the elections that was in the middle of the year. That's now out of the way. We've got the formation of the GNU, which obviously creates a lot more political stability and has been accepted by the markets. There's obviously still uncertainty regarding that, but I think it's significantly less compared to last year. Inflation is a lot lower where we are today versus where we were last year this time. Interest rates is not low, but it's lower than what it was last year and expected to continue to decline. Consumer sentiment and investor sentiment is much higher than it was this time last year. And yeah, last year we started the year with load shedding. This year we don't have load shedding, touch wood. And I actually read something that Eskom is forecasting to make a profit for the first time in I don't know how long. So it seems like that's still expected to continue, the lack of load shedding. So quite a lot of, if I just look at local factors, we had a good place or a good starting point. And just looking at asset classes, I mean, equity is still fairly well priced. So I think if we get a few things right on the economic front, local South African equity can do well this year. Bonds are still giving good returns. Even cash with lower rates still have fairly good real returns because inflation has also come down. So yeah, all in all, from a South African specific point of view, I think we're fairly optimistic and the outlook looks quite decent.